community with the hopes that you'll walk away from every Options Tribe meeting with some extra knowledge and some trading tips and some ideas that will help you to improve and become a more profitable options trader. That's our goal. So welcome to the Options Tribe weekly webinar. I want to point out that SMB Training is not a broker-dealer and that we're giving these webinars for educational purposes only. Today's webinar does not contain any live positions. Everything is hypothetical, simulated by mid prices, data feeds from computers, and therefore any performance numbers you see, any profit numbers you see, any pricing you see are hypothetical and therefore not subject to the market factors of liquidity, slippage, and commissions. I also want to point out that options trading is risky and you should not expose any of your capital to options trading until you have gotten a good solid education, read the document that your online broker has about the risks of options trading, and if you decide after that to expose capital to options trading risk, please do so on a very, very small basis relative to your net worth and your net income for quite a while before you consider increasing your capital level to anything substantial, because you need some time to understand the dynamics of options and how they respond to different market conditions, and you don't want to be learning that while you have a lot of capital exposed, and you may make a mistake because you misunderstand what's happening. So with that, I would like to welcome for the very first time John Greathouse of CorePositionTrading.com to discuss what he calls the poor man's covered call. So anybody who's poor here should listen up, and hopefully you can become rich after you're poor. So from listening to today's lecture from John and I actually got together because I did a video on YouTube and he made some comments about it, and positive, nice comments, and we started chatting, and I took a look at his website and I thought, hey, this guy has some good knowledge and some good tools to share with our options trading community. So I asked John, and he graciously agreed to attend, and present, even though he's out in California and they've got the wildfires there right now. He had a plan B going in case the wildfires shut down electricity in his area, but it turns out that's fine and there's no real issue. So John, welcome to the Options Tribe.
How you doing, Seth? Can you hear me fine?
I can hear you fine. And so what I want to do is turn the floor to you. And the way I'm going to do that, you're already there. And so John, why don't you go ahead, fire away. I do want to remind everyone that there is both a chat and a Q&A capability in Zoom, and I want you to take liberal advantage of that. If you have any questions, ask them. And then at the right time, I will put those questions forth to John so that he does not have to, track them himself. So John, fire away.
Thank you very much, Seth. I want to say thank you for everybody that's here. And I'm going to give you a straight talk discussion of the poor man's covered call. This is one of the most popular searches on YouTube when it comes to covered call writing. I'll tell you what, I get questions all the time. I love answering them, and I love talking about the poor man's covered call because it's a strategy that a lot of people can do that don't have much capital. Now, we're going to talk about that here in a minute. But before we get going, if you've never seen me on YouTube or been to my websites, I'm going to encourage you to go there, go to YouTube, search Core Position Trading, and subscribe to my channel. I bring videos once a week telling stories about my trades. We talk about them, so maybe you learn something. I really want to motivate and inspire you to get your financial education so you can have the same kind of success I am. So before we go going, let me give you a little bit of background. My story cannot be told without my best friend and mentor, Jerry. For years, I've been a day trader, swing trader, for which I had not much success, I'll be honest with you. And I met Jerry in 2011. And Jerry has been trading the stock market for 33 years. He sold a business, he made some money, and he took that money and traded the stock market for his retirement. And I'll never forget, I was trying to swing trade, day trade, and I thought I knew what I was doing. And one day I went to the gym and I was talking to Jerry, and I was really disappointed. I really thought I knew what I was doing. Years of experience, and I was a losing trader. And Jerry said to me, he goes, look, John, let me show you how to sell premium. This is how I make income in retirement. I'll show you how to do it. And Jerry, for the next year, and I know some of you are rolling your eyes, but the next year, Jerry coached me. He held my hand. He walked me through various trades. And I'll tell you what, he absolutely taught me how to be successful in the stock market. Now, look, here's the deal. I was just like everybody else when it comes to covered calls and cash secure puts. Absolutely did not want to make a mistake, right? We don't want to make a mistake when we're doing options. Well, he walked me through it, and I'll never forget, he encouraged me. I was going to sell a stock for which I had profits. And he said, John, do not sell that stock. Let's write a covered call. And that's what I did. And from that point forward, I sell premium. I sell the risk. And I'll tell you what, I absolutely love it. Now, Seth talked about a video he did for which I made comments. For me, it's all about having success. And with that success, I really want to embrace we do this, we have success, because when you're motivated and inspired, you will want to do it again. It's a rare bird to find people that are interested in the stock market for which you could just talk and learn from. So I encourage everybody to find something you're successful with and stick with it. So Seth, I can keep going and going and going because I absolutely love just trying to motivate and inspire people to get off the bench and get in the game. Because when we're on the bench, we don't have that opportunity for success, right? That's the way I see it. I am a half cup full guy. Look, I'm just like you, okay? 3 years ago, I'm working with Jerry. I'm on YouTube. I'm banging the videos. I'm trying to learn about options. And the first thing that jumped out at me, options has a lingo, right? It has a language, and there's a learning curve. And it can actually be a hurdle for which you won't stay interested. You won't be motivated and you won't have the success, right? Well, 3 years ago, I did a video for Jerry. We were talking about very specific trades, and I wanted to talk to him about a trade. So I did a video, and I posted that video, and next thing you know, 3 years later, I have over 300,000 YouTube views. But what I try to do is bring it straight talk style. And that's how Jerry taught me. So again, I want to keep it as simple. And what I really try to do on my YouTube channel is to bring it down to a level for which the most inexperienced person will get interested. Because if you get interested, you might do it. Now, with that said, we got a lot of salty dog cover call writers on my channel, and I try to give them a little bit of something every time I talk about a trade I do. But going forward, just understand, I won't be using lingo such as intrinsic value and extrinsic value. We don't talk about theta. I don't talk about a synthetic diagonal trade. For me, again, let's bring it down. So intrinsic value in an option is real money, and the theta or extrinsic value is going to be time value. That's how I learned. That's how I present it on my YouTube channel. And a lot of people like it. They keep coming back. So let's go ahead and talk about what we're going to talk about today, okay? We're going to talk about the poor man's covered call. Now, I know for some of you more salty dog options traders, you're going to get this right away. You really are. But here's the deal. What we're going to do is we're going to go through a couple trades. We're going to look at the different scenarios. I'm going to show you the tracker I created. But more importantly, I want you to stick around because at the end of this webinar, I'm going to show you the number one question that I get asked, and I have an answer for it. So I want you to stick around, and I think you're going to enjoy that one. And I think you're even going to agree with me why it is the number one question. Now, the poor man's covered call is a very popular strategy, and the reason for that is because of its name. When people go to YouTube and they type in poor man's, tons of things come up. And it's quite simple, right? If you don't have that much money, then you're going to be attracted to things like the Poor Man's Real Estate Covered Call Writing, which is a video series I did, Poor Man's Covered Call. It has hundreds of thousands of YouTube searches. So this strategy is very popular, but it's very complex if you don't know what you're doing. So we're going to define the trade strategy here. It is a covered call strategy. Now, please, as we're going through the slides, don't hammer me over the head if I say we're going to write a covered call. We're not covered in this trade strategy. We are protected, and I'm going to explain that here in the next couple slides. We're going to compare the traditional covered call with the poor man's covered call. We're going to talk about the basics of what we have to do with regards to buying a leap option so we are protected versus buying a stock. We're going to talk about being protected versus being covered. What we're looking to achieve, I have 3 hypothetical trades, the good, bad, and the ugly. We have some important key notes at the very end. I'll tell you, a lot of people ask me, what kind of leap we should buy, what kind of stock we should invest in, this, that. I get tons of questions. We're going to try to answer those on that very important slide there with important keys. And of course, at the very end, I have the number 1 question. Now, Seth, this goes back to what I was talking about. I love to bring it down, right? I love to bring it down to where we really bring it straight talk style so we can understand it. This is the official definition for the poor man's covered call. It's credited to Tasty Trade, for which years ago they did a video on the poor man's covered call. Well, here's your definition right here. Poor man's covered call is a long call diagonal debit spread, and it's used to replicate a covered call position. Now, it's called synthetic covered call. For me, I don't know about you, but if you're eager to learn, right? You're eager to learn something new and fresh, and you hear about the poor man's covered call, and you hear that people are having success with it, and you read this, I'm going to tell you right now, that is absolutely going to be the hurdle for which you do not get in the game. Here's the straight talk style of what the poor man's covered call is. Poor man's covered call is a trade idea where instead of buying shares of a stock, right? Because when we write a covered call, we own the shares. We're going to give somebody the right, but not the obligation to take our shares from us. Well, instead of buying the shares, we're going to buy a leap call option for protection. You're going to find out later that that's going to give us protection. We're not covered, and it's going to be cheaper. That's where the poor man's come in. Now, here's the deal. We are selling short-term call options just like a covered call writer, okay? So we're replacing stock ownership, which is capital intensive, with a leap call option, which is less expensive. So again, we're replacing stock ownership with a leap call option. We're protected, not covered. Now, that's very important to understand, because if you're new to buying options, you need to understand there is a huge difference there. Being covered means that you own the stock, and if you write a covered call and fall off the planet, your shares will be taken away, or that trade will expire worthless. If you buy a leap, right, if you buy that leap call option, well, because you bought the leap and you're writing near-term calls, there's going to be a debit in your account, and you could lose on your leap call option. So with buying options, there's more risk. Now, with that said, being covered doesn't mean we're avoiding risk. It's just less risky when we compare the two. So let's go ahead and talk about why this is so popular. I already explained the name. It's very, very easy to get caught up in the poor man's part of that. But I'll tell you, at the end of the day, it can be quite expensive. Now, it requires less upfront capital, okay? This is a key selling point for anybody advocating for this strategy. So I'll just give you an example. We're going to talk about Microsoft here in my example, but let's just use Microsoft right here. If you're going to write a covered call on Microsoft, you have to own at least 100 shares. Microsoft's trading for $140. You'd have to have $14,400, right? Or something like that. Well, with the poor man's covered call, we're going to buy that leap call option, and we're going to probably buy a 10% in the money leap call option. We would spend much less, a couple $1,000 versus the 14, 15 grand. So that's very important. Also, cash on cash gains is a very seductive thing for somebody, because remember, if I'm only investing $5,000 in this leap call option, I'm generating all this near-term covered call profits. Well, those profits are real near-term profits, as if you own the shares. So, for example, if I bought a $5,000 leap option and I made a $100 profit on a near-term covered call, well, that profit looks much better when we compare that to the $14,000 I would have invested had I bought the shares. So the cash on cash percentage gains far outweigh what you can make owning the stock. Now, with that said, you also have an opportunity to make money on that leap call option. I mean, if everything goes your way, you're buying a leap call option for a little bit. If that trade goes your way, that leap call option is going to increase in value as well while you're writing the near-term covered calls. So it's a twofer, and you can actually make more money. So it is very popular because of the less capital up front.
So better returns, basically, you're saying.
You can definitely have better returns if it goes your way. So now let's define the trade idea. By purchasing that leap call option in lieu of the stock, we are buying the right, but not the obligation to take someone's shares. Okay, this is very important because ultimately we don't own the shares, right? And if you write a call, a short-term call, and your shares are taken away, well, we need to be protected. Okay, we want to clear the debt in our account. And I'm going to talk about that later. But the point here is this. We are protected with the leap option, but that comes with an asterisk, okay? Because if this trade goes bad and now the stock is falling, your leap option is falling, and if the stock falls under your strike price for your leap option, well, guess what? You're not covered anymore. So it's very important to understand that when we buy this leap call option, we are buying protection. We're not covered. Okay, I'll be real quick here. The basics for a covered call. Okay, again, the basics of a covered call. We own 100 shares of optionable stock. We're going to write or sell a covered call by offering those shares to the greater stock market for a price we pick, which is a strike price, you know that, for a time frame we pick, that's the expiration, and we get that per share credit or per share premium. That's our profit. That's the idea. When we write that covered call, we're looking to generate that nice 30-day covered call premium. We own the shares. We're going to give somebody the right to take our shares away from us for a time frame we pick and a strike price we pick, and we pocket the difference. Well, in the traditional covered call, what does that do? Most people will tell you it reduces your cost basis. Now, personally, when I write a covered call, I spend the money. So I'm not reducing anything when it comes to my cost basis. But most traditionalists will say, look, when you write that covered call and you collect that per share premium, you're reducing your cost basis. Well, when we write that covered call, we're adding additional percentage gains, right? I mean, the stock might move up and down, but if we're writing 3% covered calls every month over month, we're adding percentage gains. And also, we could be generating income. A lot of retirees love using and learning the covered call strategy. They have a lot of shares. They want to generate extra income or income in retirement. So they'll use the covered call strategy. Now, the poor man's covered call, again, same idea, but we have different goals. The poor man's covered call basics are this. Again, hate to repeat myself, but we're buying the leap call option in lieu of the 100 shares of optionable stock. We then write the covered call as if we had the share. Okay, so the function of this is the same, but we're holding this paper for which we could take somebody's shares from them to cover us or protect us, but we're writing those near-term covered calls as if I own the share. We're picking a strike price, we're picking up an expiration, and we're collecting that premium. So it's the same idea. We're generating cash on cash percentage gains on that money. We're generating income by selling those call options, and we're generating a possible profit from that leap call option. So although they're very similar, they're not really, because if you talk to a covered call, a traditional covered call writer, they look at it like there's not much risk, but there is some risk. But a poor man's covered call trader understands that this is an exercise in selling premium. Okay, so the breakdown of the trade, really here, I think by now you salty dogs already get this, right? But here's a trader's tip, because I get this question all the time. When we buy that leap call option versus the stock, right? Think of the strategy for a second, okay? We own this leap call option and we paid, let's say, $5. We paid $5 for this leap call option. So we have the right to take somebody's shares, and we paid $5 for it. So that's our debit. Well, if we're looking to write near-term covered calls, the idea here is we really don't want our shares taken away from us. Because what we want to do, we want to play the long game of this. We want to write a covered call for 30 days and hopefully it goes to expiration. We keep the premium and we do it again. So really, it's important. We want to use lower volatile stock. I mean, if you pick a stock that jumps $20 in a day, well, if you wrote a covered call or you sold that near-term call and the strike price was only $10, you're just going to find yourself managing these trades a lot more. Now, in that case, you'd be profitable, but the point is you're looking for less volatile plays so you can just pick off the low-hanging fruit, as I like to call it. Right? So that is a trader tip I like to use. I have my favorite stocks. They're a little less volatile. I'm able to put that strike price out there enough where I don't think my shares are going to be taken away. That sort of rolls into the next trader tip, is that we're selling out of the money strikes here. We're not going to we're not going to sell that near-term call in the money. We need to write these out of the money strikes. So it's something we really need to understand. We're writing out of the money. Some at the money premiums look juicy and very tempting, but at the end of the day, you really don't want your shares taken away. You don't want to manage the trade. It's more work, might cost money. Let's use those out of the money strikes. And I even mentioned that there in step 3, managing the balance of the near-term call options and not losing money on the leap call option you purchased is the way we're going to be profitable in the end with this strategy. I've said this 3 or 4 times, but I think we have to really hammer the nail with this. Being protected in this strategy is different than being covered. I think some people think that when they buy this leap call option, they are protected and things will just happen if their shares are taken away. It's very important to understand we are buying the right? We're buying the right to take somebody's shares, so we're protected. Meaning, if we get to the end of all the trades that we're hoping to do, and the last trade, our shares are taken away, or the idea here that the shares are taken away from our account, we're able to produce those shares. And that's why the leap option is very important. It's very important to understand. You don't want to be underwater. So let's talk about this leap option. This too is I get a lot of questions on this strategy. I'll tell you, just a side note here, Seth. Years ago, I did a video series called The Poor Man's Real Estate Cover Call Writing, where I talked about using covered call writing to generate near-term income similar to real estate investors. And when I did that video series, a lot of people hit me up about the poor man's covered call. So it really forced me to learn the strategy, do the strategy, and then I did so many videos on it. It's just fun to talk about. But here's one of the questions that I get all the time, because it's very subjective. Some people, when they buy this leap call option, they will go so deep in the money, they almost want the option to be trading 1 for 1. Now, I'm going to explain this here in a minute, but what I like to do when we talk about buying this leap call option, what I like to do is I like to buy the 10% in the money leap call option.
You mean the stock price, 10% of the stock price is the amount that you're in the money?
Exactly. Yeah, because this is what we have. So if you look at a leap, like you look at a couple years out, you pick a strike price that you want. Say, for example, Microsoft's trading at 140. And we're going to look to use this strategy, the poor man's cover call with Microsoft. And by the way, I'm not advocating that. But with that said, I'm looking for that 10% in the money. Now, remember how options are priced, okay? We have real money and time value. Now, if we're buying a 10% in the money call option, that 10% is real money and the time value is our real cost in this trade, right? If nothing happens, it's that time value, which is our cost. And this is why I said this before I started this sheet, where some people will go so deep in the money where they will go $25 and $30 and $50 in the money. Now, I like the 10% because when I pick my lower volatile stocks, I'm only paying maybe $1, maybe $2, depending on the company I'm using. Mm-hmm. And to me, I think I can write some near-term calls pretty quickly, 1 month or 2 months, that covers that time value. And if the trade goes my way, the stock is going higher, my call option is going higher, right? So I'm paying off the time value cost here. So with that said, let me just rehash on this. The leap call option, the 10% in the money leap call option, has 10% of the option value in real money. And the other portion, of course, is time value. And that That is our real cost here. I told you we were going to use Microsoft as an example. Probably should have picked a cheaper stock, but I think we can really visualize this trade right here with these numbers, okay? Let's do this hypothetical trade. Microsoft's trading at 144X. I'm going to buy the 10% in the money, leap call option. The leap call option at the time that I'm going to put on this trade was trading for $27. Now that's quite a bit of time value there, and that's probably why I should have picked another stock, but we're going to go with it. But do you see how of the $27, right? We're buying the right, but not the obligation to take somebody's shares from them at 130. I'm paying $12.39 because $14.61 of this is real money. Meaning if I execute this trade and I want to bail on it immediately, I'm at least going to get that $14.61 in real money back. So it's very important to understand the leap call option, understand its pricing, and understand what the true debit is. That $12.39 represents what we need to beat, right? We need to beat that. We need to hope that Microsoft trades sideways to higher. This $27 leap call option doesn't decrease in value. What we're really hoping to do, and I sort of glossed over it in a couple slides ago, we need to have the balance between having a profitable leap call option, a profitable stock sideways to higher, and of course, there's our debit. We need to be doing the near-term call options to pay down that debt.
Anonymous attendee is asking how you getting to 1239 as time value. And the answer, Anonymous, is the stock's trading at 130. At 144.61, and the 130 call therefore already has value of 14.61 in it, because that's how much that is in the money. The 12.39 is the excess of above 14.61, which makes the total of $27 for the option. So the 12.39 is the time premium. The 14.61 is the value that's the intrinsic, what's called the intrinsic value. It's already in the option. Anonymous asked that question kind of a couple different ways. I just wanted to make sure that he understood. He said he did, so that's great.
Well, Seth, if I can interrupt you,
Yep.
that is one of the biggest hurdles for new options traders, understanding the pricing of an option.
Right.
Because if you don't understand the pricing of an option, you may find a lot of your trades are not profitable just
Yes.
because of that right there.
Now, Matt is asking, how far away in time is this particular leap call?
2021, I believe. I apologize for not putting that here.
All right, so that's probably, so that'd be what, at least 14 months out, maybe longer.
Yeah, exactly. And let me just quickly mention that a lot of times, if you go to YouTube and you watch the Poor Man Cover Call videos, they're going to tell you a leap option can be 6 months to 2 years. And from my experience, I love using the much further out call option because we have time. We can really work this trade, do it multiple months because we have time. That's important.
Now, Sean is asking, are there certain market events where you would look for good poor man's covered call trades? For example, do you wait for volatility?
This is great.
And then look for the PMCCs because you'd be getting, I'm just going to add, because you'd be getting paid more for the call in a volatile environment.
Yeah, most definitely. Sean, you are on top of it. And chances are you've seen my channel and my videos on the Poor Man Cover Call, because where my success comes is I have my basket of stocks, right? I have my list of stocks ready to go. I've done my homework. And when they come out, bad news or an event, man, I look to buy that leap call option on a bad day, because as you know, we get a nasty down day where our favorite stocks are down some 10%. Man, we could just slip in and pick up some great call options at a good price.
Mm-hmm. Actually, there's one more question I think everyone would be interested in, which is the ones you're selling, how far into the future are those? If the leap is, 12 to 14 months away, how about the short call? How long into the future are you selling those?
So I've mentioned it a couple times. The sweet spot for this is that 30-day covered call.
Okay.
And when I say covered call, I apologize. In this situation, it's a protected call, but it's really that 30-day to 45-day, because that's where we're going to get the premiums that really make this worthwhile, right? I mean, if we're selling an out-of-the-money strike, the only way we can really get some good premiums is if we add time to the trade. But of course, we don't want to do a 3-month trade because the likelihood of the stock getting above our strike and then us managing this trade, we don't want that. So we want to keep it a little bit tighter. I like the 30-day, the 45. But here's the deal, Seth. You can do this with any option expiration. You just have to be prepared to manage that trade.
And finally, John, do you ever try to time the sale of the option to get close to earnings so you can get a greater premium?
I'll tell you, another great question. Look, the golden rules of covered call writing. I'm just going to go back to my foundation, okay? My foundation is the golden rules of covered call writing. And one of them is this. We don't want to trade around earnings because of that volatility. I just recently did a video on Nike moving 12% either way on an earnings report. We're talking about Nike. So yes, I do absolutely love selling premium around earnings. Now, with that said, I make it very clear to my YouTubers that that's me, right? I'm from the day trader, swing trader mentality, but I use the selling premium strategy. So I'm sort of a hybrid where I am traditional in a sense. I love writing the cover calls, but I love adding a little juice to my game. So that answer is yes.
All right, then why don't you go ahead and continue?
Here's the setup, and you know what we're looking to achieve. We're going to try to now write some near-term calls, collect that monthly income, the 30 days to 45 days, and we're going to pocket that money. Now, we want to manage these trades so the shares are not taken from us, so we don't have to manage them. So what we're really hoping to do is write some out-of-the-money strikes, hoping the stock goes higher, but never finishes above the strike price. So we can collect the premium and do it again. And look at that. That's exactly what we're looking to do. We buy the leap option, and I think it was Matt or Sean talked about buying it on a volatile day, so we get those cheaper call prices. We buy that leap. We have that paper in our hand, giving us the right, but not the obligation to take somebody's shares. Now we can start writing covered calls, right? I feel protected. And that's what we do. We write the near-term covered call, and then what we hope is that the stock will reach the strike, but peel off. So it will expire worthless, or we buy back the option days before expiration, alleviating the obligation. Now, again, if we wrote an out-of-the-money strike where Microsoft might not get there, we don't have to worry about that. So as you could see, this is the idea. Now, this is a very short window. I've heard of people selling near-term premium 25 and 30 times and never having their shares taken away. That is a salty dog. So that's the idea. Now, one thing I want to mention before I move on, because I'm going to show you 3 trades, the good, bad, and the ugly. Notice we don't own the stock. We collect no dividends. So when we're looking at earnings for volatility, you also need to look at X dates. A lot of people will buy stocks, making them a little more volatile during X dates because they want to own the stock. You really have to be on your game. I mean, you have to be on your game if you're going to use this. You can be successful, but you have to be on your game. You have to know when those volatile times can happen. So here's our 3 trades. I think at this point, I hope it's clear. We're buying the right to take somebody's shares, which gives us that protection. There's a cost with that. So here on your screen, you see on the left, you see the red. That's our debit. What I did is this. I created a spreadsheet for which I'd keep my debits on one side, my credits in the middle, and then on the left, you really get to manage the trade. And in this case, this is that Microsoft trade that is the good. If you look at the trades, you could see we did the January 2021, we did the 10% in the money, we bought 1 contract, and we had a cost at the time was $27. Now, that green box you see, that's a calculation of where you're at with regards to in the money versus what you paid. And you're going to see in the next 2 slides how that can go bad. But with that said, we have our debits on one side. Now we're keeping track of our near-term 30-day covered calls. And as you can see on the various dates, I'm writing covered calls. Again, protected calls. I apologize. And you can see how we're generating that cash on cash gain. Do you see how the cash on cash gain is 22%? Well, remember, we only invested $2,700 versus over $14,000. And then as you can see, as this trade comes to an end, for whatever reason you want to close this trade, look what we did here. The stock is trading at $155.95. We've written all those near-term covered calls, and we're going to sell this option, this leap option, for $38. So not only do we make money on the near-term covered calls we're writing, selling premium, but we're going to make money on this leap option as well. So this is why I call this trade the good. Now, here's a trade where it's touch and go, okay? And this is where most of us will find ourselves because, when you buy a stock, if you haven't done your charting, right, you haven't done your due diligence on the charting, sometimes buying that leap option when the stock is at the top of resistance, the stock might fall, right? So getting back to buying your leap option when we have volatility or a down day, for me, that's what I want to do because it's more likely the stock might go higher. And in particular, if you're buying great companies, huge S&P type companies, usually Wall Street comes back and buys them up. So we get that likelihood of the stock moving sideways to higher. So with that said, most people will buy this leap option, start writing near-term covered calls, and they find themselves in a spot where the stock is not performing. And as you can see, it's touch and go right here on this hypothetical trade. The stock is now trading at 134. Look at our leap call option value. We are losing money on the leap because if we had to cash that leap out, we're down some $23. Now notice we're still generating that near-term covered call income right down the middle. Boy, I'll tell you, if you got nerves of steel, you can keep doing this time and time again. Hopefully the stock recovers and it moves higher. Again, that near-term premium that you see right in the middle, that is paying down the cost of your leap option. Now, in this case, if this trade were to end right here, yes, you invested $2,700. Yes, you made 22% on the near-term call premium. That all looks good, right? But at the end of the day, we're losing serious money with that leap call option. That's what I mean by managing this trade and understanding, keeping the numbers in front of you. And again, before I go, we don't want our shares taken away right here, do we? We are protected. We are protected. Remember, we own the paper to take somebody's shares away from them at 130, but we're in a bad spot. Now, finally here, I'm going to be quick on this slide because I think we all get this. We are in trouble. We're in trouble right here. Now, hopefully, because we bought the 2-year leap, we have time, right? And if we're writing those out of the money strikes and we're managing the trades, we can continue. Even in the face of us losing money on this $27 call option, you can still manage the trades. This goes back to Seth talking about having your financial education, having your experience. You can still write the near-term calls because you have time on your side. You just have to make sure those near-term out-of-the-money strikes are managed. You do not want your shares taken away. You'll probably be buying back all of your options 3 days before expiration. Now, Seth, in my example, the good, because I think we all understand the good is where we want to be. We invested $2,700. That cash on cash return is 22% on those near calls. We made 40% in this hypothetical trade on our long leap, knocking down a total of 63% on this trade. So as you can see, the poor man's covered call can be cash on cash more profitable than stock ownership. Now, Seth, we're almost at the end of what I'm going to bring you today, but let's talk about those key notes because this might answer some of the questions some of you folks might be having. So again, it's very important. We don't want our shares taken away, largely because we have to manage the trade. If you make a profitable trade using the examples I talked about today, well, that's fine and dandy. But really the idea is we want to do this multiple times a month, our go-to multiple times a month so we can generate that near-term call option profit. Notice, I haven't talked much about implied volatility. We know if we're picking high volatility stocks, right? Higher implied volatility for the stocks that we pick, the likelihood of them going beyond the strike price might be pretty good. It's going to cost you money to manage the trade. Whether it's time or money, it's going to cost you. These days, all these brokerage houses are zero fees, so maybe there isn't a cost, but if you have to manage this trade, you're on vacation managing a trade, that's taking time away from your family. So again, we want to make sure we're using lower volatile stock. Now, when buying the leap call option, we want to reduce the time value portion of the option. I hope I made that clear today. When you buy a in the money leap option, your in the money is in the money, but it's that time value for which you have to make up. That's what you are working towards. You have to reduce that time value because that's your true debt. And once you get past that, now you're pocketing. But again, if the trade goes good, then you can sell that leap for more money. Mm-hmm. Now, most poor man covered call traders will buy back their in the money options. Okay, I want to be very clear here. When I say in the money options, real quick, they've written an out of the money covered call. I'm sorry, Seth, I keep saying that. I'm so conditioned to talk about covered calls. We have written that near-term call option. We're selling that call option. It's out of the money. Man, we pocket that per share premium. Now the stock goes higher and now it goes above our strike price and now it's in the money. If we don't want our shares taken away or a debit in our account or managing the trade, we have to buy it back, right? Mm-hmm. We have to take that obligation off the board. And most poor man covered call traders will buy the option back, adding to their cost basis, but they already got it dialed up to do the next 30-day call. Okay, it's very important. And a lot of people suggest 3 days prior to expiration, but understand the second you enter any selling premium trade, you may have to take action because somebody can take your shares or assign you shares. Okay, so it's very important. Buying this leap option on huge down days gives us a great opportunity to buy a cheaper call option for that favorite company you pick, okay?
Sure. If you get a bounce, that call is going to get very valuable very quickly.
Yes. This is the number one question because the reality is this never gets addressed. You know, I can challenge you right now to go to YouTube, type in Poor Man's Covered Call, and watch a couple videos from all of those legacy videos you'll see out there. And they don't talk about what happens on expiration. You know, does this leap call option magically exercise? What happens if my shares are taken away and I don't have the shares? So I'm going to answer that question right now. The number one question that never gets addressed is what happens if I forget on expiration Friday to buy back or close a trade that's in the money? I don't have the shares. What happens? Well, your answer is this. Your brokerage is not going to execute your leap call option. A lot of people think they will, right? They think you probably think you own this leap, you're going to exercise it. Hell, the brokerage will do it for you, but it doesn't. What happens is this. It expires, that trade, that near-term call option expires, and you have the debt in your account. They're going to give somebody the shares or cash, but your account is going to be minus the strike price in your account. So Monday morning, you will have to take action, okay? And whether that means you exercise your leap call option or you deposit money, your brokerage will not execute your leap call option for you.
It's interesting that that's the number one question. It's a pretty sophisticated question if you've never been exposed to covered calls before. So I'm impressed by that.
Most definitely. So if you have any questions, feel free to hit me up. Seth, do you have anything you want to hit me up? Otherwise, that's what I have today.
Well, that was really great and really energetic. Obviously, you love what you do and you're enthusiastic about it. Steve G is saying, I've been doing this for a long time. A couple of things: make sure your leap is deep in the money to give you a higher delta. The deeper in the money, the less extrinsic value, and make sure the spread on the contracts are not too wide. So I don't know if you'd agree or disagree with that, because you're saying don't go super deep in the money. You're talking about going in 10%.
Well, Seth, the reason I don't agree with the super deep in the money is because most people don't have $50 a share to be buying, right? So for me, I want to find that perfect mix where if somebody has $5,000 or maybe a small ball account of $10,000, they could actually buy a nice leap call option that doesn't have that much time value, but they're not buying a call option that's $50 and $60. So that's really why I love that sweet spot of the 10% in the money. And by the way, he's exactly right.
Okay. Well, I think that probably the best thing to do, I'll give you all my email address in a minute. But the best thing to do is if you had any further questions you really wanted passed on to John, send me an email. I'll give you that in a minute, and I'll pass that on to John. And you could also go to John's YouTube channel, subscribe, and you could ask the questions in comments. Or John, aren't you planning to record today's webinar and then post it on your YouTube channel?
I sure am, Seth. And
so
Seth,
then maybe when you get it posted, people can put forth their questions as a comment on
most definitely.
That would be another way of getting things accomplished. So either way, I'm happy to get your emails if you want. I'll shoot them over to John. So you want folks to download the free PMCC tracker, right?
Yes, most definitely. And if you just give me one quick second, and I know a lot of you say, man, this guy can't be one quick second on anything. Seth, I want to say thank you for this opportunity. And if any of you liked what we did today, okay, if you liked what you heard today, I want you to email Seth, let him know, because I have so many other things that we do on my channel that excites all of the new YouTubers that come to my channel and all those salty dogs. I'll tell you what, I try to up everybody's game. I try to motivate. That's what I do. I hope I came across as someone that is genuine in the sense that I want to up your game, telling you my stories. And yes, go to my website, CTP Dashboard. I have the free Poor Man's Covered Call Tracker. It's there for you. Download it. I don't charge you nothing. And go to my YouTube channel, Core Position Trading, subscribe, because I'm going to have another red hot covered call video for you this weekend. Hey, Seth, I appreciate it. And for all of you out there, hey, look, until next time, may all your covered calls be profitable.
That is great. That's great. That sounds like that's the, I'll bet you that's the way you end some of your videos, huh? With that comment?
Yes, sir.
Yeah, that was a wild guess. All right, so with that, I want to just make some quick announcements for everyone, and the first one is